Hello everyone and welcome to Momentum channel. My name is Mo and in this video I'm going to be talking to you about Canadian banks. For investors out there that are looking for blue chip stocks to invest in with a longer term horizon, wanting to collect a reliable dividend income, Canadian banks are among some of the best options out there. Canadian banks have been very reliable through tough times. Think about the recession years, think about the financial crisis that we had back in 2009, most even recently. They've been paying their dividend continuously over these tough times for decades now. Very reliable in that sense. And not only they're reliable from a dividend payment, but also from a stock perspective and stock performance, they've actually done quite well. In this video, we're not going to be taking a look at the dividend or the stocks for each of these banks separately, but rather giving you an alternative way of looking at it. What if you could consider investing in all major Canadian banks? We are talking about the top 6 banks directly through one basket of them, through an ETF, exchange traded fund, that allows you investing in one ETF, and indirectly you're getting kind of investments of in all of those banks at the same time. That's what an exchange traded fund essentially does. And the best part about it is that then you don't have to worry too much around, ensuring that you don't get overexposure to one bank versus the other, or having to make sure you do the rebalancing, or having to do a lot of research, because these ETFs take care of that, all of that for you at a very kind of reasonable price. The management expense ratio that we're going to be talking about are quite decent. It's nothing that you have to worry too much about. In other words, nowhere close to that of the 2% or 1.5% or even sometimes 3% or so of a mutual fund. You're talking about fraction of a percentage point. We are going to be looking at 6 of those ETFs here in this video. I haven't looked at the covered call ETFs, and it's intentional because when you talk about covered call ETFs, their approach is different and their focus is a lot more creating more of a return for you short term through those covered call approaches. But the downside to that, I've noticed that they limit really your overall growth of the fund. So you're letting go of that at the expense of having a much higher yield. For me, given my age range and many of my fellow investors, I think that a normal ETF that invests in these funds directly, not so much trying to apply a covered call, might be a better tool, at least for at this time. But again, depending on your investment horizon, your age range, and where you are in your investment journey, covered call ETF might be another thing for you to consider. For me, I think that covered call is more probably suitable for somebody later in their retirement days, when you're getting closer, whereby they rely on a lot much higher income, and not too much caring about really the valuation of the performance of their funds. All right, just to quickly show you how Canadian banks, in this case we're looking at only the top 4 of them, given that you only have option of comparing them here. Royal Bank of Canada, Bank of Montreal, and Bank of Nova Scotia, and Canadian Imperial Bank, these 4, how they've done over the years. This goes back to long ago, ever since Royal Bank of Canada was around 1983 in terms of the stock price. Look at how amazing they have all done since their inception, as showcased here on MSN Finance page. The Royal Bank of Canada has actually knocked it out of the park with close to 2,700% return that you do see here. If I just remove a few of them and maybe add back other top 6 banks, so if I add back Toronto Dominion Bank and National Bank of Canada, you do see how actually National Bank of Canada has also done amazingly, quite well, up 3,200% since its own inception. With that out of the way, we're going to take a look at our first ETF, which is by Hamilton. It's Hamilton Canadian Bank Equal Weight Index ETF, the ticker symbol HEWB. It has a yield of 5.44% annually, and it claims to be the lowest fee Canadian bank ETF. And if you look at their management expense ratio to judge that, you see that the management expense ratio here is only at 0.19%, quite low for a Canadian bank ETF. And if you look at it, what their holdings are, as the name suggests, for the most part, they are equal weightage. You have exposure to the top 6 banks: Bank of Nova Scotia, Canadian Imperial Bank of Commerce, National Bank of Canada, Bank of Montreal, Toronto Dominion Bank, and Royal Bank of Canada. This fund pays its dividend distributions on a monthly basis. It does the rebalancing of its holdings to make sure that the weightage is accurate and the weightage is fairly equal on a semi-annual basis. If you look at the past return for this one, you're going to notice that first and foremost, of course, this fund has not been around that long. In fact, it's one of the ones that has been incepted very recently. Its inception goes back to April of 2023, April 3 of 2023. So it's really hard for you to do a proper comparison of its performance, but for that matter, we're going to take a look at its recent distributions. And ever since its inception in April, they've had so far two payments that you can see listed on their website. The amounts each time around 7 cents, roughly around that 7 cents that they paid per share. The last trading price for this fund hovered around that $16 or $15 or so per share. We're going to move on and take a look at the next holdings here. And this is one very similar to HEB, again offered by Hamilton, but this one is HEWB. It's even called Horizons Equal Weight Canada Bank Index ETF. Very similar concept. Price point is around $29 per share. I find it that the main difference here is that this has a higher management expense ratio of 0.27. So if you're interested in lower fee, you might want to go with HEB, but it has been around longer. It was incepted back in January 22nd of 2019. Other than that, it does pay its distributions, and the yield, if you look at it, is hovering closer to that 5% or so. And it's been around longer. You can see its performance, the HEWB, over the different time horizon annualized. For example, the past 1 year, it's down by 11%. The past 3 years, annually on average, it's returning close to 16.9%. And its return since inception annually is close to 7.8%. You also can see here the performance of this fund by each calendar year. 2021, they had a knockout year, returning 39% positive. And last year, 2022, they were down by 10%. And in terms of holdings, pretty much equal weightage, very similar to what we saw for HEB. We're going to move on and take a look at the next one. Another one offered by Hamilton. This one, I'm adding it on purpose here. It's although it's not using the typical just simply buy and hold type of strategy, and it's slightly looking at a leverage. It's not. I wouldn't categorize the cover call. That's why I've decided to include it here. What they do, they are using a leverage investment approach, whereby they're also holding HEB as another underlying factor beneath them. So they give you equal weight exposure to Canada's big six banks with a modest 25% cash leverage. That's why they call it HCAL, Hamilton Enhanced Canadian Bank ETF. As a result of that, they are having a higher yield of 8%. If you look at their performance in the past 1 year, they were down by 17%. The past 2 year annualized, they were down by 4%. However, the annual return since inception is close to 14.5%. They haven't been around as long as the HEWB. The inception date for HCAL goes back to October 14 of 2020. And their holdings, similar 6 banks, very similar kind of weightages, trying to be as equal as possible. They do the rebalancing as well throughout the year. But the management fee is definitely a lot higher at 0.65. So something for you to keep in mind. You're paying that higher fee because you're expecting higher annualized yield through the more active approach to investments that this fund is taking. Looking more closely here, the approach for risk assets and the holdings, you get exposure to the main banks, but you have the leverage to HEB that is incorporated within the HCAL. Next one is offered by BMO. ZEB is the ticker symbol, BMO Equal Weight Banks Index ETF. It was last traded at the price of $33.67 per share. It has an annualized distribution yield of 5%. It has a management expense ratio of 0.28. Higher definitely than that of the first one that we saw, HEB, but a lot lower than HCAL that we talked about earlier as well. Here, you also are going to be getting your distributions on a monthly basis. It is designed for investors looking for growth solutions, and it gives you exposure fully to the top 6 Canadian banks, more or less at an equal weightage. Looking at the past performance for this fund, you do notice that based on their net asset value, the 1-year return is down 11%, 2-year annual return of negative 1.3%, 3-year annual return of 16.7%, 5 years annual return of 6.5%, and 10-year annual return of 9.8%. If you look at their annualized return since inception, it's at 9.7%, which is quite decent. ZEB has its own 6 major stocks as underlying holdings, does pay its dividend distributions on a monthly basis. If you look at their market cap for this fund, it's at $563 billion. And it's available through Toronto Stock Exchange, TSX. Let's take a quick look at the holdings, more or less equal weightage to all the top 6 banks that we talked about. CIBC Bank, Bank of Nova Scotia, National Bank of Canada, Bank of Montreal, Toronto Dominion Bank, and Royal Bank of Canada. And the entire exposure is to financial sector. And lastly, the next holding for us is RBC Canadian Bank Yield Index ETF. As the name suggests, it's offered by Royal Bank of Canada, but again gives you exposure to all top 6 Canadian banks. This one is actually available with ticker symbol RBNK, has a management expense ratio MER of 0.32%, slightly higher than ZEB. What's noticeable as well here is that they also do pay their distributions on a monthly basis. It has around $248.5 million in assets under management. Looking at the price range for RBNK, its last trading price was at $22.80, which is hovering a lot closer to its 52-week low price, which was at $21.89. The 52-week high price was at $25.87. Keep that in mind. It could be a good opportunity for many of these Canadian banks, given their recent poor performance, to pick up some of these stocks or possibly ETFs that we are reviewing. If we look at their return based on the net asset value, the last 1 year is down by 15.9%, 3-year annual return positive of 14.8%, 5-year annual return of 5.5%, and annual return since inception is at 5.2%. You also see their return by calendar year 2021. It did really well at positive 40+%. And year to date is down by 4.3% as of end of May. We are going to be taking a look at the exact holdings, pretty much the funds that you see, the 6 different banks. The main difference here is that you're not getting equal exposure. The exposure is different all over the place. What's hilarious and kind of funny about it is that even though this whole ETF is offered by Royal Bank of Canada, their exposure to the shares of Royal Bank of Canada in this ETF is actually the smallest of all at only 7.9%, and the highest exposure is to CIBC. I'm not sure if it's intentional or why is exactly that way. Keep in mind that this is one of the funds that you're not getting the almost equal weightage. So it's very selective which ones, based on the fund managers and that they are managing this fund, they're putting more weightage on. So in that order, you have highest exposure to CIBC, then Bank of Nova Scotia at almost 25 to 26%. Then you have TD and Bank of Montreal at almost 16%. And following that, you have National Bank of Canada and Royal Bank of Canada at close to that 7 to 8% exposure. And you can see the latest dividends that they've paid. All the dividend income paid so far this year, you're getting close to that 9 to 10 cents per share. And lastly, we have one fund that is different from the rest of them. Here, you're getting exposure to the top 6 Canadian banks, but also other financial funds, investments and insurance and other type of stocks in Canada. It's called iShares S&P Toronto Stock Exchange Cap Financials Index ETF. So it has more diversification as a result of that, with ticker symbol XFN. Last trading price was at $44.63. It has a year-to-date positive return of 2.74%, which is unlike the other ones that we saw so far, because the top 6 banks in Canada did not do well. Most of them were actually negative. Here, you're looking at the past performance based on the total return. 1 year is down by 7.9%, 3-year annual return of 14.9%, 5-year annual return of 6.3%, and 10 years annual return of 9%. If you look at their annualized return since inception, it's close to that 8.9%. Here, you're getting exposure to 29 different holdings instead of just 6 banks, hence more diversification. You get your distributions on a monthly basis. And the yield is hovering around that 3.6%. Let's take a look at the fee. The management expense ratio here is at 0.61%, a bit higher than some of the recent ones that we saw. But if you look at all holdings, let's take a quick look. Of course, you're going to start off with top 6 banks, mainly Royal Bank of Canada, Toronto Dominion Bank, Bank of Montreal, Bank of Nova Scotia. And then next we have something other than that, say Brookfield Corporation, but you also go back to Canadian Imperial Bank of Commerce. National Bank of Canada is still on the top 10, but you have a few other holdings before then: Manulife Financial, Sun Life Financial, Intact Financial. If I go to the next page, you see you have some other institutions here. Everybody, of course, every one of them are in financial sector. Things like TMX Group, Onex Corporation, IGM Financial, Definity Financial Corporation, Power Corporation of Canada, you name it. So I'm just going to go through the rest of them, give you an appreciation of what different holdings and funds they have. Everything is in financial sector, but if you look at the more specifically by type of industry or breakdown of those, you get some exposure to the banks, mainly 66%, then insurance at 21%, and financial services at 12% or so, and very small exposure to cash and or derivatives. Well, there you have it, folks. A quick look into these 6 ETF that allow you to invest in Canadian banks and, or as to the last one that we talked about, more broadly, more diversified to other financial sector businesses in Canada. Let me know what you think of these funds. Are you invested in any of those, and which Canadian bank are you mainly interested in to invest in? I would love to hear from you. I hope you enjoyed this video and gained something of value from it. If you did, don't forget to smash that like button and subscribe to our channel. Here on Momentum Finance, we post weekly videos about investing, including investing in ETFs, stocks, dividend stocks, growth stocks, and we also talk about ways to reach financial freedom. Thank you, and I hope to see you all next time.